In this episode, I will explain the London reversal daily profile in detail, show you how to properly identify it on the charts, and how you can use it effectively in your trading. So let's get straight into it. The first thing that needs to be understood when we're talking about daily profiles is the importance of sessions and kill zones. If you don't understand how the market behaves during different sessions, it becomes very difficult to build a proper daily narrative. On the screen here, you can see the kill zones marked out. We have the Asia session, the London session, New York AM, and New York PM. Each one of these sessions has its own behavior, volatility, and purpose within the daily range. Now, even though all sessions matter, we're not going to focus on every single one of them. Instead, we're going to narrow it down to the sessions that typically give us the best opportunities and the cleanest moves. For me, that's London and New York AM. When it comes to the London session, I'm mainly focused on the window between 2 and 5. This is usually where we see expansion, liquidity sweeps, and the formation of the daily high or daily low. London often sets the tone for the rest of the day. Then we move into New York AM. Officially, many traders define it slightly differently, but personally, I focus on 8:30 to 12. I extend it out to 12 o'clock because that gives enough time for the full New York move to develop, especially after major news releases around 8:30. So when I'm building my daily profile and forming a bias, these are the two key windows I pay the most attention to. London from 2 to 5, and New York AM from 8:30 to 12 o'clock. Understanding these time windows is the foundation. Once you know when the market is most likely to move, you can start focusing on how it moves within those sessions. Now, what is a London reversal? A London reversal is essentially a classic expansion candle that forms during the London session. It follows a very recognizable pattern once you understand what you're looking for. In a typical bearish London reversal, the candle will open, move higher first to form a high, and then reverse direction. From there, it expands aggressively to the downside, takes out liquidity below, and closes lower. So the sequence is simple: open, push up, reverse, expand down, and close. For a bullish London reversal, it's the exact opposite. The candle opens, initially pushes lower to manipulate and sweep liquidity, and then reverses. After that sweep to the downside, price expands upward, forms the high of the session, and then closes bullish. So in simple terms, a London reversal is when price opens, manipulates one side of liquidity, and then expands strongly in the opposite direction within the same session. It's a very clean model once you train your eye to see it, and it often sets the tone for the rest of the trading day. So what does that actually look like on the lower time frames? Let's take a bullish London reversal as the example. The day opens, and during the London session, usually between 2 and 5, price drops lower. That drop is not random. It's typically a liquidity run. It sweeps sell-side liquidity and creates the lower wick of the daily candle. So during London, price is effectively forming the wick of the daily candle. After that manipulation lower, we then look for a change in the state of delivery or a market structure shift on the lower time frame. That shift tells us the manipulation phase is likely complete and that price is ready to expand in the opposite direction. Once London establishes that reversal and shifts structure, the New York session often continues the move. So the sequence becomes very clear. London manipulates and reverses. New York continues and expands. In a bullish example, London creates the low of the day or near it, shifts structure, and then New York drives price higher. That's why we say London reversal, New York continuation. When you understand that sequence, you stop guessing session direction and start anticipating how the day is likely to unfold. Similarly, with a bearish London reversal, the concept is exactly the same, but in the opposite direction. The day opens, and during the London session, typically between 2 and 5, price pushes higher first. That push forms the high of the session and often sweeps buy-side liquidity. In many cases, this becomes the high of the day or very close to it. After that high is formed, we want to see a shift. That could be a change in the state of delivery, a market structure shift, or even an inversion, however you personally define confirmation. The key point is that London runs liquidity to the upside and then shows signs of reversing. Once that London reversal is confirmed, New York comes in and continues the move to the downside. So the sequence here is London forms the high, shifts structure, and New York delivers the expansion lower. When this plays out cleanly, it completes the open high, low close sequence of the daily candle. London sets the high, and New York drives price down toward the low, shaping the daily profile. Now let's jump into the charts and go over a few examples so you can see exactly how this looks in real market conditions. All right, let's go through this example again step by step. This is our bullish London reversal example. London opens around 2 a.m. New York time, and during that window price usually takes liquidity on one side before committing to direction. In this case, price opens and sweeps the lows that were formed around the open on the 15-minute time frame. That sweep tells us sell-side liquidity has been taken. After the sweep, we drop down to the lower time frame for confirmation. On the lower time frame, we have an inverse fair value gap, and that is what we use for our first entry. Once price trades back into that inverse fair value gap, we execute the trade. The stop loss goes above the recent high, and now we let London deliver. As price continues higher, and we approach the 9:30 a.m. New York Open, this is usually where I'll secure partial profits. At this stage, I'm expecting New York to possibly create a pullback, or sweep some internal lows before continuing higher. And that's exactly what happens. Around the 9:30 open, price sweeps those internal lows. Now after that sweep, we drop back down to the 1-minute time frame and look for confirmation again. This time, for the second trade, we are going to use a CISD and an order block for confirmation. Once we get the change in state of delivery, that tells us momentum is shifting back in our favor. Then we identify the order block that forms from that move and use that as our entry point. At this stage, I can trail the stop loss of the original London trade to the new low formed during the New York pullback. Now both positions are protected below that level. For targets, we aim for the buy-side liquidity resting above, since we are aligned with a higher time frame bullish narrative and price has already taken sell-side liquidity. And as you can see, price moves very cleanly into those targets. This is a clear example of London providing the reversal through the liquidity sweep, and New York providing the continuation, first using an inverse fair value gap, and then using CISD and an order block for the continuation entry. All right, guys, that's going to wrap up this video. By now, you should clearly understand how the London reversal and New York continuation model works, step by step. You wait for liquidity to be taken during London, you look for confirmation on the lower time frame, and then you execute with proper risk management. If New York gives you a pullback and another confirmation, you can use that for continuation. And remember, this exact same framework applies in the opposite direction as well. This is how you're going to use these concepts in a bearish market. Instead of sweeping lows during London, you'll be looking for London to sweep highs. Instead of looking for bullish confirmation, you'll be looking for bearish confirmation. And instead of targeting buy-side liquidity above, you'll be targeting sell-side liquidity below. The structure is the same, only the direction changes. Once you understand that, you don't need a new strategy for bullish days and another one for bearish days. You just apply the same model based on context. If this video helped you, make sure to like the video. It really helps the channel. If you want more ICT-based breakdowns and session models like this, don't forget to subscribe. If you want to connect with me, you can join my Telegram and Discord. The links are in the description. If you want to learn personally from me, check out the mentorship link below. And if you're interested in funded accounts, I've left discount codes in the description as well. Trade safe, manage your risk, and I'll see you guys in the next one.